Luke.
From OnPoint Mortgages. We don't normally do this together.
That was cheeky.
Aim of tonight is we're just going to give you an insight. Mortgage lending can be quite difficult. That's not the insight. Not everybody knows that. But it's going to become easier. Lenders are going to become more flexible. And there's going to be more creative solutions for those that are underserved by the industry at the minute. So we'll show you what we mean. So this is a graph. This graph shows why the private rental sector isn't going to go anywhere soon. So if you look at that black line, that's the average mortgage payment. The green line is the average cost of renting. Often we get first-time buyers who say, this is crazy. I can afford that rent, why can't I afford that mortgage payment? It's because the FCA, a few years ago, said that you must stress test the mortgages at 3% above the interest rate. So actually they're testing to see if you can afford it at that yellow line, which is why first-time buyers find it difficult to get on the ladder and why the private rental sector isn't going to go anywhere, in addition to various other reasons. This here goes back to the popularity of 2-year fixed rates as opposed to 5-year fixed rates. So if we go back 2 to 3 years, Brexit was announced, people started to become cautious. In addition to that, sorry, I'm annoyed. In addition to that, these pillars are in the wrong position, aren't they? In addition to that, the PRA, who regulate buy-to-let mortgages, they introduced tougher rental stress testing, which meant that if you one way to get around that tougher rental stress testing, be able to borrow more money, was to fix in for 5 years. So what you can see for both residential and buy-to-let lending, 2 to 3 years ago, the number of 2-year fixed rates started to drop, and the number of 5-year people taking 5-year fixed rates started to increase. What that means is 2 to 3 years on, interest rates are still so low at the minute that lenders can't compete on rate. In addition to that, we're 2 to 3 years on from the popularity of 5-year fixed rates exploding. So this year, there's less 2-year fixed rates coming to the end of their term, and there's less remortgage business out there for lenders. In addition, the number of purchases started to slow down and plateau in some areas. There seems to be a bit more optimism in the market after the general election and Brexit. People just have the certainty. What that means is there's less purchase business, there's less remortgage business, and they can't compete on interest rate because rates are already so low. So how will lenders compete? They'll compete on criteria. And we're already starting to see in the market lenders starting to become more flexible with their offering, and they're looking out for niches in the area, some of which we'll show you, in which they can find good quality clients. Over to you.
So one of the things that Lee touched on was the rental coverage calculations changing, and one of the reasons that people were moving to 5-year fixed rates was because of what we call the PRA consultation paper that came out, and the PRA basically said to banks and building societies in the UK, you need to be making sure that the buy-to-let landlords can afford their mortgages based on the rental after the tax changes that come in this April 2020. So the new industry standard, it used to be that the rent had to cover the mortgage by 125% if the mortgage interest rate went up to 5%. Now obviously because of the new changes for high rate taxpayers especially, we're seeing a new industry standard of 145% coverage at 5.5%. So that most commonly affects any investors, you guys really. So London, South East, those higher valued properties that just have, the rents just haven't quite kept pace. So here's an example. I don't know why we've used Hendon. We're in Worthing.
It's Worthing wrong.
But we've got an example of a rental calculation. You can see the maximum loan, how that's been affected by the new tax changes and the new PRA consultation paper. Now there is a couple of things we can do there. First one is using personal income. So if you are a high income earner, 40,000 upwards really, then you can start to use your personal income in order to increase on those loan amounts despite those changes in rental calculation. The other one is 5-year fixed rates, which we didn't touch on, and you can get, because they have to stress test the interest rate over the next 5 years, if you're fixing in for 5 years, common sense dictates that you are able to get a slightly better rate of stress testing, so you can see how the maximum loan is increased on the right hand side. I love this picture.
It's a holiday let it work.
Yes. So, as Lee mentioned, those lenders are really having to widen up their criteria and the types of let they'll do. As investors' appetites are changing, people are looking to get the most out of their property investments, and a few of the ways of doing that is through multi-units. And so you used to just do HMOs, now do multi-units. Lenders who used to do just single lets are doing HMOs, and so on. We're seeing a lot more of the holiday lets and serviced accommodation spinning out from Brighton and getting to Worthing. We're seeing the regeneration of Worthing, so hopefully that's an up and coming area of business. I always love mentioning this product. It's Lendable Foundation Home Loans. Not many of you would have heard of them, but if you're into serviced accommodation, they're a fantastic lender out there. One of the biggest barriers that people come across with serviced accommodation is experience, because it's a business. Lenders want to see that you have experience in running that business. Slightly different to a single let, where you can give it to a letting agent, typically that will be looked after. It's a lot more hands-on. Now, what Foundation Home Loans have come out and said is, well, if worst case scenario, we could let it as a single let, what are we concerned about? So Foundation Home Loans are offering short-term let products, which do allow you to let on Airbnb. A lot of lenders came out and said we don't support Airbnb, they will support Airbnb. There's no minimum income requirements as well, and their rates are pretty competitive as far as limited company mortgages are concerned.
So a lot of investors will be looking to add some value to the property, and then what they want to do is, once they've added that value, be able to refinance as quickly as possible so they can pull some money back out and move on to the next project. A common question we get asked is, when would I use a buy-to-let and when would I use bridge finance? A buy-to-let mortgage is based on the rent you receive. Technically, with some lenders, they'll put an offer condition in there saying that you must let the property within 30 days. Doesn't give you a huge amount of time to add value to the property. In addition, some lenders will have a condition that says 3 months. So sometimes, if you're clever, you can choose the right lender that might allow you to not let the property immediately and do a bit of works beforehand. Now, what that doesn't necessarily help is if you take out a buy-to-let mortgage, you're then might be tying yourself into an early redemption penalty if you want to get out of that loan. So there's a few different ways in which you can get around that, and we're going to show some of them now. One of which is a bridge loan. So historically, people have had a perception of bridge loans that they're expensive, but there's a lot of competition in this market, because especially when it comes to investment properties that are regulated, it's fairly easy for people to get into that market of lending. So bridge lending, the amount of lending passed 3 billion for the last year. That's tripled the size in 2007. Lenders are becoming faster. I always say about the lender I know that can lend you up to $500,000 in 48 hours, no valuation, no legals. Now, I'm not saying to go down that route, it's more expensive, but you get what you pay for. The technology, they're introducing more technology, and also they're allowing bridging for a variety of reasons. That's the new bridge, that's going to solve the issue.
Should we lose on Google Images, should we?
I'll get better pictures next time. But bridge financing trends, cost is coming down because there's more demand in the market. Loan to value changes. There are some lenders that are becoming more cautious, and maybe they lend 75%, now they're lending 70%. There's others that are going from 75 up to 80, and that 80% loan to value is going to be their niche. Market correction. You'll see some bridge lenders that don't have a unique offering leaving the market, so do be careful about the bridge lender you use. Make sure your broker's done a due diligence on that bridge provider. Location. A lot of bridge and development lenders were very focused on London. It's very difficult to make deals stack up in London now, so they are looking further afield, and then looking at more in the southeast, Worthing as well as up north. And we won't mention that at the Worthing property then. And then there are some products out there called bridge to let. So what you can do is you can take out a bridge loan with a lender. They will then provide the buy-to-let mortgage, allowing you to get off that bridge loan. The benefit is when the surveyor goes round to survey the property for the bridge loan, you'll normally get the same surveyor that goes out again on the exit finance, so you'll have an idea of of what the end value is going to be for your numbers. It just de-risks the whole situation by staying with the same lender. Here's an example of some bridge rates out there. Headline rates don't mean a huge amount, you know, it's 50% loan to value on those headline rates, but it just shows you some of the starting rates out there. Was this you or me?
This was me. So we wanted to speak about Interpay. They're a big player in the market. They're part of one savings bank. You might know their younger brother, which is Kent Reliance, who do a lot of HMOs. One of their better products for larger scales, going over 30 days, involving a sledgehammer, usually, you can go up to 75% as a facility. Now, bridging works slightly differently, and I won't go too much into detail. Come and see us afterwards if you do want to discuss it. But effectively, they start off on a gross loan, and you calculate interest based on the amount of term you are going for, and they give you a net loan, and that's actually the cash money you receive. On this example, there's a 2% arrangement fee. I'm not sure there is a lender that doesn't have a 2% arrangement fee. That's quite typical, and a 0.64 per month. And the net advance, funnily enough, always tends to be around 67 to 69% of the purchase price. So slightly more deposit required when you're doing those works.
On bigger deals, their arrangement fee goes down to 1.2% on loans £1 million upwards.
It's titled Kent Reliance announcement, but it was an announcement last year, wasn't it? That they will accept day one remortgages, and we're seeing a lot of investors using this to its full advantage, where they're adding value to HMOs and pulling money back out. The one caveat is you're limited to 75%. However, I met with Kent Reliance a couple of weeks ago. They are now giving commercial valuations as well. They will also, after 6 months mortgage payments, allow you to further advance up to 85%, which makes them a bit of a market leader in terms of maximum loan, in that they're using commercial valuations as well. They will allow capital raising, so if you're raising the money to invest in another project, you can certainly do that. And its lending is based on the current property value as opposed to the purchase price. Typically, that's the issue with refinancing within 6 months of purchase, is you're limited to purchase price plus cost of the works, which is no good to any investor. We want to go off of that market value, which Kent will allow us to do. I sort of covered this one, but it's effectively it's useful for cash buyers, auction purchasers, properties that aren't initially mortgageable. So if you're using things like the Interpay bridging finance, or doing a refurbishment, that's what it's for. Now, the criteria requirements, it's usually quite a short conversation over working out whether someone can get lending with a lender like Kent Reliance, because they don't have many requirements. There is no minimum income for buy-to-let, no credit scoring, only a credit check, just check you're credit worthy. First-time property owners are allowed, first-time HMO landlords are allowed. As I mentioned, further advance after 6 months, and they've got 25% loan to value, and they'll give enhanced rental calculations, which we mentioned earlier as well.
So its criteria is not just becoming more flexible for property investors, the same thing is happening also on residential lending. And a lot of property investors are quite often self-employed, and it's an area of the market that has been neglected over the last few years. So there are some lenders out there. Typically lenders would use an average of 2 years, before it used to be an average of 3 years. There's lenders out there that will just go off your latest year's tax return, which if it's a strong year, could make a big difference in terms of how much someone's able to borrow when buying or remortgaging their home. There are lenders that will do just 1 year accounts. You don't need to necessarily have been trading 2 years anymore. There are some lenders, if you run a limited company, you would pay yourself in salary and dividends. Now, previously, limited company directors, when they wanted a mortgage, they would have to maybe draw down dividends that year to support their loan, but actually they didn't need to. It'd be better to keep that money within the business and not pay the tax on it. There's now lots of lenders out there that will use, instead of salary and dividends, they'll use salary and your share of the retained profit in the business, which means you don't necessarily need to draw that income down. Another option, if anybody's a contractor, we do quite a few mortgage people in the TV industry. They typically work on short-term contracts. There are lenders out there, if you've got a long enough period of contracting, they can work off your day rate as opposed to your tax